Let's talk to Federico Bentley. He's a sales trader at Ayondo. Morning to you, Freddie.
Morning.
Right, nine thought-provoking slides. Without further ado, let's get into the nitty-gritty. What's the first one?
First one, well, as we normally start off with just talking about sort of one of our top traders. This guy, he's been performing pretty well. You know, we've spoken about him before. He's mostly a Dow trader, trading about 50 times monthly, so fairly often. Does very small positions, but they sometimes add up. He might sort of have 7, 8 positions open at any time. Normally trades with a fairly wide stop loss, so the risk per trade may be sort of maybe 2%, but it's, you know, about 2,000 point stop loss. And his take profit, which has been, you know, fairly efficient, it's about sort of 300 points away. And obviously the Dow's had some fairly large sort of fluctuations.
Yep.
He's up about 7% for the year, which is fairly, you know, it's definitely outperforming the actual benchmark. We've seen a lot of volatility this year, so he seems to be just above water, which is good to see. Fairly low risk score of 1. You know, he's been trading for us for about 2 years, so, you know, a bit of track record. And on the next slide, we'll be able to see his sort of risk per trade and his take profit. You know, the main thing on the far right is the take profit are, you know, they are being hit fairly consistently, which is nice to see. You know, at the end of the day, when someone's got a strategy and it's being sort of productive and efficient, it's, you know, one of the main things to see, I guess.
Okay. So basically, his risk profile is quite good. He's been with you for a while.
Yeah.
Do people see the transactions in real time?
They do indeed, exactly. Okay. So you'll be able to see any open positions, you know, what price you got in, where a stop loss is at. Yeah. So it's all real time.
Okay. And if you're mirroring these trades, okay, you can see these.
Yeah, exactly. You'll get a notification straight away. The risk per trade will be exactly the same. So if you're following a 1-to-1, if he's risking 1%, you're also risking 1%. What may differ is the stake size. Obviously, it's proportionate to your own account size.
Yeah.
Everyone will have a different account size.
Okay.
So if you have $1 million in there, obviously yours is going to be a lot larger than someone who's only got, you know, 50,000 in there.
Okay.
But it's all proportionate. So, you know, the percentage, I guess, which is the main thing, is exactly the same.
Yeah, understood.
So
okay, so just finally on that slide, okay, if you're mirroring somebody, okay, and they've got a position at all times, you know what you're mirroring.
100%. So you know exactly what you're mirroring. You can also sort of de-risk it. If some traders are trading 5 products and one of them might be, let's say, gold, or Bitcoin, for example, you can always minimize that to 0, so you have no exposure to that particular asset class. Okay. And you can always close the positions early. You don't necessarily have to rely on these guys. If you're running a profit of, you know, 500 quid or whatever it is, you can close it out early. Okay. And then stop losses.
So you're kind of in control of the...
You are. It's kind of managed funds, but fairly lenient. You know, you still have full control.
So you've still got the override button.
Yeah, exactly. And, you know, everything's so transparent. You know exactly what the costs are, what the overnight charges are. So it's a lot more transparent than, you know, your typical sort of managed funds, I guess.
Understood. Okay, well, let's talk about bear markets. Capitalised by short selling. What's this telling us?
Yeah, I guess, you know, a lot of people normally look at the traditional side of just, you know, going long. You know, the last 10 years we've been on a bull market and it hasn't really stopped. And people sometimes sit on the fence when things start to become a little bit volatile. But there's always, you know, I guess, opportunity out there. So I guess just to sort of make aware that, you know, you can obviously all just go short of the market. You know, with us, you can do it in a traditional way. You just hold it 1-to-1. And whether you're looking for the long term, you know, if you're looking at the overall market on the UK side, you can always just short the FTSE. Have your stop losses in there. Obviously, we offer guaranteed stop losses for free, so you always have your sort of your maximum risk, I guess. Again, you can do that on the Dow Jones. On the tech side, obviously, there's been a lot of, you know, the tech bubble in 2000. There's been a lot of noise surrounding the current FANG stocks, which are up, you know, about 30% for the year. But you know, things do turn around. You know, there are cycles. So if you are a bit worried about that, you can always use it as a hedge. You know, if you just want to short the actual NASDAQ itself, if you're holding Facebook, Google, Apple on the long side, and you just want to have some type of hedge, you can always just go on the short side. You know, sell the actual NASDAQ itself and have your guaranteed stop losses in there, your take profits, and just manage your risk a little bit safer. You know, in these current situations, you know, there's almost nowhere to hide. It's been quite tricky. You know, you're looking at something as gold, you know, it's fallen from 1,300 to about 1,250. Yep. So when you're looking at sort of safe havens, the traditional safe havens seem to be not as obvious right now.
Understood. Okay, well, let's have a look at a selling example.
Yeah, I guess looking at examples, obviously we saw Facebook, the massive privacy scandal where they sold about, I think, 87 million people's, I guess, data. You know, off the back of this, and over 10 days, over 2 weeks, you know, the stock jumped down about 18%. So a lot of people, you know, were able to take advantage of that. So I guess it's just showing you how you can do that with Ayondo. You know, you don't just have to go long with these stocks. Sometimes people have the perspective and the view that you can just buy stocks, you can only go long. You know,
with, I guess, a trick there, aren't you?
Yeah, with a traditional broker, maybe that is true. But with us, you can do it the same way as you do it with a normal one-to-one cash equity, but you just go on the short side. Obviously, a month later, that the stock climbed back as it is Facebook. The likes of Apple, you sometimes see them jump down $10, $20, and recently they have been jumping back up. But if you're able to capitalise on that sort of small gap, there is a huge potential there.
Understood. Okay, so let's move on to the second part of that.
Yeah, so going from examples now to sort of potential opportunities, we've obviously got quantitative easing ending towards the end of this year. We've had this for the last sort of 4 or 5 years, and it's just, the market's just massively inflated. So if the markets does start coming down, all this money's not being as populated and I guess invested across the markets, you might see the overall European sort of indices come down. So there's potential there to maybe short the Nasdaq, the DAX, the FTSE, the CAC. There is that potential there. And looking at the FTSE itself, we've got a massive record debt of about 390 billion,
Wow.
which surpassed the pre-crisis level. So you're looking at pre-crisis level, that's 10 years ago. These things do sort of happen in cycles. So if you're looking at from that perspective, in the previous example, you can just short the FTSE. If it does fall, 2,000 points, at least you've actually been able to capitalise on a bear market. Bear markets aren't always a bad thing necessarily, especially if you're there attentive and you are, looking for the next example.
You make your money quicker in bear markets.
Yeah, you do, but obviously it's a bit of a risk. But looking at most of the oil companies, I think BP and Royal Dutch Shell, they're mostly indebted. About 15% of the overall debt is from these two companies, especially in the oil market. So you've got potentials there. Obviously, what's been surfacing the news recently is the trade wars between US and Europe, US and China. I think about 50 billion of these imports will be, I guess, tariffed about 25%. I think the first 34 billion will be done on Friday. China will be retaliating. So there's a lot of potential there. Someone like Tesla, whose main market is obviously the US, but the second main market for them is the Chinese market. So if you're looking at someone like them, that could be potential to go on the short side. The car makers have been massively in the news. Volkswagen, they're saying they're going to lose X amount of revenue. So there's a lot of potential there. And on the next slide, you can see Tesla's sort of share price since it's, I guess, been surfacing. I think they're looking at about 50% tariff for Chinese buyers if it goes through. Obviously, if the Chinese retaliate, it will probably be mostly imminent. I think the way they're doing it is the first 34 billion will be done on Friday, and then the rest, the 16 billion, will be done in the coming weeks. But the Chinese will most likely retaliate, whether it's car makers, soybean, sort of agricultural business. So obviously here with the Ayondo, you can always do it one-to-one. You don't necessarily have to be trading on leverage. You can always short it as an actual one-to-one. So you're paying no financing. You just hold it on the long side. You just hold it for X amount of days, X amount of months. And again, you can always flip it. If you've benefited from the short side, you've made a couple thousand, you can always turn around and get a discount, which is, I guess that's the tricky bit.
Absolutely.
Yeah.
Okay, so in terms of the next slide, let's talk about the investing with Ayondo post the correction.
So obviously we've been talking about shorting, whether it's several indices, stocks, usually they sort of flatten out. Whether it's a 20, 30% correction, a lot of people, someone like Warren Buffett likes to buy things at a discount. So it could be a good potential to buy, many stocks at a one-to-one and just hold them for the next 5 years, and hopefully that they'll get back to their pre-crisis levels. And with Ayondo, you have the variable margin, which not many brokers do have, which is the same way as doing it through Hargreaves Lansdown, one-to-one. But because it technically falls under a spread bet, you pay no capital gains. Right now the allowance is about 11,700. Anything above that, you pay either 10 or 20%. And with that, you're still receiving 100% of UK dividends, 85% on the US side. But the main thing is you're not paying any financing costs. So if you're holding, let's say some of the banking stocks, Barclays, HSBC, for 4 or 5 years, your only cost really is a spread. And it's another sort of alternative to an ISA. With ISAs, you can only technically invest 20,000 a year or add 20,000 a year. With Ayondo, it's the same concept. You can just add as much as you'd like, of course.
Makes sense. And Irish clients avoid 33%
Yeah, exactly.
capital
Irish
gains.
clients seem to have the highest capital gains sort of in the world, it seems. 33% is, ridiculously high. And their allowance is only about sort of 1,100.
Right.
So there's no leeway there, I guess, in comparison to the UK guys.
Okay, so let's move on to long-term holdings. So this is like a basically buy and hold like a traditional stockbroker,
The same concept. But obviously, as I mentioned, you could pay no capital gains. So if you're doing it with Hargreaves Lansdown, even through your bank, you might hold some shares with your bank. You do have some monthly fees that they might be minimal, but they do add up, whether it's £10, £20 a month. with Ayondo, you do the same concept. And a lot of people they don't understand it as well because it's too good to be true, but it's fairly simple. It's the same concept, you just pay no tax. People don't believe it, but once you try it out, we have a lot of clients who test it out, dip their toe in the water, and then they understand it's exactly the same concept.
Yeah.
And then they'll move, their most of their portfolio over from whether it's the States or their main holdings over here. Because if you're paying no tax, there's no difference, is there? Unless you want voting rights, which, if you've got 3% or over, fair enough, but that's the only difference. You don't get any voting rights if you're doing under a spread bet, which at the end of the day, all you really want is the profits, I guess.
Okay, let's wrap up with the last slide.
Yep, so zero balance protection. Obviously, we've had this since 2015. Obviously, under the ESMA regulations, a lot of brokers have implemented this, but what they have also done is they've only implemented it for the retail clients. For their professional clients, they've taken away the benefit of the zero balance protection.
Right.
With Ayondo, we cover both retail and professional, so there's no difference whether, it doesn't really matter at the end of the day for us, which is a benefit, I guess, for the professional clients who are getting this, I guess, scrutiny and this pressure from their various brokers.
Freddie, on that note, we've run out of time.
Yeah.
Thank you very much.
Thank you very much.